Forget picking one stock and praying, what if a single $1,000 split 3 ways could give you a front row seat to artificial intelligence, the global energy market, and the next trillion-dollar drug revolution all at once? We're talking Alphabet, Chevron, and Eli Lilly. And before you scroll past, let me tell you why serious money is paying very close attention to these 3 names right now. The setup here is almost too clean, and that's exactly why it deserves skepticism before it deserves conviction. Markets are volatile, sentiment flips overnight, and the moment something looks like a sure thing is usually the moment the universe laughs directly into your brokerage account. But here's the case anyway, starting with Alphabet, the company that basically owns the on-ramp to the entire internet. Between Google Search, YouTube, and Google Cloud, Alphabet isn't just participating in the artificial intelligence race. It's one of the few companies with the infrastructure, the data, and the distribution to actually win it at scale. Their Gemini model integration into search is the kind of product development that quietly prints money while everyone else debates whether AI is overhyped. Advertising revenue goes up when search quality goes up. Cloud contracts follow enterprise adoption, and suddenly that stock starts looking less like a bet and more like a toll booth on the information superhighway. Now slide over to Chevron, which is essentially the boring uncle at the portfolio dinner party who quietly has more money than everyone else at the table. With a 3.5% dividend yield and the balance sheet muscle to stay profitable even if oil drops significantly, Chevron is the kind of position that pays you to wait while geopolitical chaos keeps energy prices elevated. There's a beautiful irony in the fact that while Silicon Valley promises to disrupt everything, the world still runs on hydrocarbons, and Chevron has been cashing those checks since 1979. You don't have to love fossil fuels to appreciate that this company hedges your portfolio against the exact kind of macro uncertainty that tech stocks hate. Then there's Eli Lilly, which has somehow turned appetite suppression into one of the most explosive revenue stories in modern pharmaceutical history. Mounjaro and Zepbound aren't just drugs, they're cultural phenomena generating the kind of demand that has supply chains scrambling and analysts revising price targets upward every single quarter. The skeptic in the room will correctly point out that Eli Lilly trades at a premium valuation, and that's a fair concern worth sitting with before committing a single dollar. But when you layer in their oncology pipeline and early-stage Alzheimer's research, you start to see a company that isn't just riding one wave, it's paddling hard towards several more. Historically, the investors who compounded the most wealth weren't the ones who timed every cycle perfectly. They were the ones who found durable businesses, sized their positions rationally, and let time do the heavy work. The pattern here is almost embarrassingly consistent. Strong moat, growing addressable market, and management that allocates capital intelligently tends to outperform the noise. Now let's kill a misconception before it kills your returns. This is not a get-rich-quick thesis. And anyone framing a $1,000 stock investment that way is selling you something other than sound strategy. The real edge in owning names like these is the compounding effect over years, not the dopamine hit of a single green candle on a Tuesday afternoon. The practical lesson from every market cycle going back decades is that position sizing and emotional discipline matter infinitely more than being right about a specific prediction. You don't need to be certain these 3 companies will outperform. You need a strategy that survives being wrong and still benefits when you're right. So here's the framework. Diversify across sectors, size each position to a level where a bad quarter doesn't wreck your psychology, and resist the urge to constantly adjust based on headlines designed to make you feel behind. The market rewards patience with a compounding interest rate that most people dramatically underestimate until it's already working in their favor. At the end of all this analysis, the most honest thing you can say is that no one knows exactly when these positions pay off, but the structure of the thesis, built on real earnings, real moats, and real demographic tailwinds, gives disciplined investors something solid to stand on. Comfort with uncertainty isn't weakness. It's the actual prerequisite for building long-term wealth. Whether these 3 stocks become your best performers or just your most educational ones, the discipline of building a process, researching fundamentals, sizing rationally, and staying the course is the real return on this exercise. The $1,000 is the tuition. The process is the degree. And if you're ready to take that same disciplined, structured thinking and apply it to building wealth through real estate, connecting with reliable contractors, or finding the right lenders to fund your next move, check out our links in the description below. We're here to help you get started.